We had exactly the same thing last time Trump was elected. The dollar was strong, rates went up, liquidity contracted, the market had a big rally, which is Bitcoin. And then in January, because of the lag, what we found was a sharp 27% correction in Bitcoin. And then it ripped higher. Ripped higher so much, in fact, that it went up 23x. Now, I'm not expecting that because this was a much earlier cycle. But what we're saying is that correction is not to fear. That correction is just a marker point from phase 1 of the banana zone to phase 2 of the banana zone.
If history is any indicator, the next Bitcoin mega rally could be just one sharp dip away. That's the latest insight from Raoul Pal, CEO of Real Vision and a seasoned macro investor. Crypto investors often look to past market cycles for clues about the future, and right now, Pal sees several signs of bullish momentum. The last time Donald Trump was elected, the dollar strengthened, interest rates climbed, and liquidity briefly tightened. Yet, Bitcoin still experienced a significant surge, followed by a 27% pullback in January, only to skyrocket by an incredible 23x soon after. While current conditions may not be an exact replica of that earlier cycle, Pal emphasizes one key takeaway: short-term corrections often pave the way for massive gains. Stay tuned until the end of the video, as Raoul Pal shares even more valuable insights you won't want to miss.
Hi guys, hope to see you guys at Dubai Token 2049. We have exclusive 10% off the limited super early bird tickets. Click the link below. This pass will grant you access to speaking sessions, networking app, exhibition hall, daily networking drinks, and also included breakfast, lunch, and coffee breaks, all included the package. I'd love to see everyone there. Peace out.
Phase 2 of the banana zone usually goes into US tax season, which is like April. Then there's usually a consolidation because people have to sell tokens to pay taxes. And then there's usually phase 3 of the banana zone is the rip into year end. And that's all driven by the liquidity cycle. So we can see these banana zone periods as they start appearing. Bitcoin just does this every time, like Doge does. So we've just broken that part of the cycle. So this is the start of the banana zone as we start accelerating higher. Going back to liquidity, here's Global M2. You see, Global M2 does this a lot. It also wedges. I love a wedge. They're the best chart patterns in the world. And what happens is it has a break higher, then this consolidation. It's happened every time we've got to the banana zone period, the kind of US election cycle, stuff like that. So we've done that. We've corrected the breakout. Now, Global M2 is actually driven by the strength of the dollar. Now, the dollar has started to weaken. We expect it to weaken going forwards. And that will then reignite the next phase of the banana zone as we start bouncing higher. You can see those corrections in M2 were short. Now, the reason being is we've got to roll all of this global liquidity. We've got massive amounts of debt to roll over, and you need liquidity to do it. So that is the game, the big game, the everything code game that I've talked to you about. So the everything code game is very much at play. This is a phase, the early phase of the breakout. This year is the year of liquidity, and that's why the year ahead, and that's why the banana zone plays out so beautifully. So we talked about Global M2 being driven by the dollar. So let's look at the dollar. And also rates is the other part of financial conditions and liquidity. So what we're finding is that the dollar, as you can see, and rates had moved away from trend. That was the strength that we saw. This is what creates the down move in global liquidity. Now, what's interesting is the Citi Economic Surprises Index, which is an index of whether the economy is beating forecasts or underperforming forecasts, says we should now have a period of underperforming forecasts because it was driven by the tightening conditions from the dollar and rates. Now, obviously, we know if the economy starts underperforming forecasts, like we just saw the unemployment rate rise to 4.2%. Once we start to see things like that happening, what happens is people start thinking about we need to cut rates more. So that's a very interesting thing. So here in white is rate cuts priced in. very few rate cuts priced in. So there's like, I don't know what the scale is here, but there's very little rate cuts priced in, but it's driven on a forward basis by the dollar and the long end. So it's now saying, as we weaken economic growth, we should start to see rate cuts. And then, as you can see, we're starting to see the pickup again in financial conditions, which is important, and I'll come to that in a minute. So when you put it all together, they're all the same thing. Fed rate cuts, the DXY, 10-year bond yields, they're all highly mirroring each other. 10-year bond yields seem to be suggesting faster and faster that the dollar should roll over and rates should roll over too. That creates financial conditions. And now what we've got here is financial conditions index, which is rates, the dollar and oil prices, has been consolidating for a period of time. And it is suggesting that the ISM, which is the business cycle, the Institute of Supply Managers survey, should be much higher, i.e. we've got economic growth to come. It leads by 9 months. So in 9 months' time, the economy will be a lot stronger than it is today. And this is going to be important for you. So all of the stuff we talked about, rates, the dollar, even oil prices, all drive financial conditions, which drives cryptocurrencies, which drives markets in general, which drives the business cycle. When we look at the forward-looking basis on the business cycle, we can see things like the Philly Fed. Well, their new orders index is exploding higher. Now, whether this is just on the Trump victory or whether it's on orders they see in advance, not sure yet. Philly Fed expectations index exploding higher. Empire Manufacturing, for that's for New York, exploding higher, all suggesting the ISM is going to be super strong going forward.
Meanwhile, Genova, a platform for commercial real estate, has started accepting Bitcoin, Ethereum, and Solana as payment for select services. The company is also considering incorporating these cryptocurrencies into their savings and investment strategies. According to Genova, this move aims to stay aligned with the growing adoption of digital currencies while making transactions more convenient for customers. They're taking cues from companies like MicroStrategy, which has seen success with Bitcoin, but emphasize that they'll approach this shift cautiously to minimize risk. Now, let's return to Raoul Pal for more exciting insights and outlooks.
Why this matters is the ISM, the business cycle, is the coincident factor for the Ethereum Bitcoin cross. So that says, as ISM starts rising, ETH starts outperforming Bitcoin. And why is that? Well, it's a function of ISM being confidence in the economy, disposable income, or free cash flows from businesses. People have more money and feel better and have more confidence as the ISM goes up. The business cycle's better. We're all earning a bit more. Our businesses are doing better. We're making a bit more profits. And we recycle those profits into investments. And we go further out the risk curve, which would be Ethereum. We might also like Ethereum because it has a yield while Bitcoin doesn't. So we might park more of our money into that yield as well to make our money grow for us. So anyway, it's a big factor for ETH Bitcoin, the business cycle. Crypto and macro are the same thing. And that's a really important thing to note. Most of the financial establishment hasn't understood this, but at Global Macro Investor, we have entirely led the way on this. We have thousands of charts. We have more in-depth research on that nexus of macro and crypto than literally anybody else on earth. And we're very confident in how this plays out. So when we go back to the price chart, hey presto, it's another wedge. This is the ETH Bitcoin weekly cross. If you remember when I started this presentation, I said, stop using too shorter term charts because all you'd see on Twitter is ETH's terrible, it's falling and it's just going to underperform forever. Look at the big picture. ETH basically is the same level versus Bitcoin that it was in 2017. It has held value over time, which is very important. It shows the Lindy effect, that this thing is around and it's here to stay. So what we're doing is bouncing off the bottom channel now, just as the ISM is about to pick up. And we either break that wedge, which is a big deal, because that would be ETH outperforming Bitcoin even further, or we stay in that larger range but get to the top of the range. My base case is we break out and ETH outperforms. Now, I know nobody can believe that right now, But ETH is a very different beast to Bitcoin. ETH is a platform. It's a compute platform. It's a storage platform. It's a huge system. Well, Bitcoin is more of a currency, a store of value, collateral layer. They're just very different things. And it's kind of stupid and idiotic that we compare them. But we're here to make money and not have a philosophical debate about what Bitcoin is versus Ethereum. What I'm here to do is help all of us unfuck our futures. And it feels that overweighting Ethereum, if you've got Ethereum, that's the way to do it versus Bitcoin. Now, the ISM also has another little piece of magic. It actually is the signifier for altcoin season. So altcoins, a percent of Bitcoin total market cap, altcoins start massively outperforming. And again, it's driven by the same thing. Optimism, a bit more money, a bit more savings in your pocket, and you wanting to make your money work for you. You go further out the risk curve. So the key signal for altcoin season is the ISM going higher, and I've showed you why we think it goes higher. All of our work suggests that it will. ISM is also, this chart is the same actually for NFTs. That's why we've started to see NFTs rise. It's all driven by the same thing. NFTs are people's savings get recycled into a long-term asset. And then if we look at the crypto total market cap, excluding the top 10, known as others on TradingView, lo and behold, a series of beautiful wedges. That wedge pattern is the chart pattern of the gods, that and the head and shoulders pattern. And here we go, and a couple of the wick-offs. And here we go. Wedge, massive break. Wedge, massive break. Wedge, I would suggest massive break. So where does this go? We're at $400 billion here. Do we go to $4 trillion? $6 trillion? It's possible. It's possible. We just have to wait and see. But, the orders of magnitude in the previous ones were much larger. It'll be less big this side. But I'm guessing we're going to see the mid-tier alts really, really start to move in value. And that's where things like Sui and Sei and Celestia and all of these things all lie within these areas, or whatever your favorite token is. And again, please do not think that you need to be a maximalist in any one thing. We're trying to outperform. Use the charts of your chosen token versus Solana. They look like they're going to outperform Solana. You're onto something good. Please don't use something that's very short term. I want to see a proper basing pattern. That's why I found Sui, because it was outperforming pretty much every token. You might find something else. Again, don't go too far overweight, away from the don't fuck this up thesis. The way to ride the banana is sensibly. It will all play out. And look at both of those charts. At exactly like whatever it is, 170 days after the halving, they both have this correction, the liquidity correction. It's all the same thing. This is the everything code. It's all driven by liquidity and the Bitcoin halvings and the patterns that emerge. So that correction, however long that takes, call it a month, 3 weeks, that correction ushers in phase 2 of the banana zone, which tends to be the violent propulsion of alts, the banana zone signature pattern. So are we overbought yet? Should we be worried? Should we be thinking, my God, what happens if it's over 100,000 and it tops here? Well, our core risk indicator is nowhere near overbought. We're still barely mid. So it's suggesting we've got a lot further to go. When we look at the log regression channel, this is my kind of chart of truth. The thing that I find is immensely helpful. Well, we're not even at the mean of the trend. So we're still below mean. Now we're going to go to 1 or 2 standard deviations. In fact, it's never not gone to 2 standard deviations. 2 standard deviations, you're talking $500,000 plus Bitcoin. Now, maybe it doesn't. Maybe the law of diminishing returns kicks in and gets to 1 standard deviation. Well, that gets you to 250,000 or so. I'm not giving you projections. I'm giving you contextualization of what an exponential trend looks like. All to play for, so there's nothing to worry about. Cycle top finder. This has been a really good way of finding the cycle top. We are nowhere there. Absolutely nowhere near. So again, chances are we'll have a little pullback in January. First we'll hit year end, a little pullback in January, and we'll just keep ripping higher until we eventually hit the cycle top.
Bitcoin's current trajectory aligns closely with historical patterns seen during previous halving cycles. Risk indicators suggest that Bitcoin is not yet overbought, as it remains comfortably in the mid-range. According to Raoul Pal, an analysis of the log regression channel supports this view, with BTC currently trading below the trend's mean. If Bitcoin follows its historical trajectory, a move to one or two standard deviations above the mean could push prices to $250,000 or even beyond $500,000. While diminishing returns might moderate the rally to some extent, the broader trend remains firmly bullish, with no signs of an imminent cycle top.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.